Welcome to our continuing series on the reform of the Kenyan Income Tax Act, and today we look at a topic that's a little bit different, and this is thin capitalization. And with me to discuss the thin capitalization provisions in the Kenyan Income Tax Act is Alice Morethi, who's part of the PwC Kenya tax team. Welcome, Alice.
Thank you, Titus.
Okay, so maybe let's just start from the very beginning. Thin capitalization has been a feature of the Kenyan Income Tax Act, but just tell us, what are the main provisions of the thin capitalization provisions?
So, thin capitalization refers to the mix between debt and equity. There are two main ways you can finance a company, through debt or through equity. So what thin cap does is try to curb excessive interest deductions where you have excessive debt. And most legislations, Kenya included, have a fixed ratio of debt to equity. So the whole essence is try to curb how much debt you can have compared to equity, so as to make sure you do not have excessive interest deductions.
Okay. And these thin cap provisions have been in the legislation for quite some time and for a number of years. Are they consistent with the kind of the thin cap provisions that you see in other jurisdictions, or are there some sort of distinct differences that kind of put us out of sync with international legislation?
So I would say there are like two main differences between the way our thin cap legislation is written and the way the international practice is. First of all, our thin capitalization is quite wide. It covers both local debt and international debt or offshore debt. And it also covers both related party debt and non-related party debt. So I would say it's a bit out of sync with the whole spirit of thin cap legislation, because use of excessive debt is more prone by multinationals, because they're the ones who are able to control how much debt they can put in a particular country compared to other, say, a local group. Okay.
And are there other areas where the thin cap provisions might be seen as being out of sync with global standards?
I would say it's the use of fixed ratios of debt to equity without really checking whether the ratio is in a particular industry. Because say for some industries like the oil and gas industry, you'd need a lot of financing, and therefore it would be logical that you would require more debt compared to other industry. Or even for certain public sector projects such as infrastructure or power, where you'd ordinarily need more debt compared to other industries.
Yeah. So I think I've seen in other jurisdictions where the taxpayer is required to benchmark what the ratio should be, and whether he's within sort of an international, the benchmark for the debt equity ratios that would be expected in that industry. Now, do you see a loosening of these thin cap provisions to move towards a less prescriptive debt capital ratio? Or do you see that there is some hesitation towards moving to such loosening?
I would say it would be difficult, given that our legislation is not sector specific. So for example, for you to know what's the right amount of debt, there would have to be some sector specific legislation written for a specific industry. So long as our legislation continues to be quite broad and generic, then it will be difficult for us to prescribe ratios without a sector specific focus.
Yeah. And if I look at the BEPS, the Base Erosion and Profit Shifting project from the OECD, that has also kind of made fixed debt capital ratios a bit redundant, and has recommended a different way of looking at thin capitalization provisions. Now, just tell us a little bit about that, and whether you think that this is the direction that maybe Kenya should head.
Yeah, so maybe I could start by giving an overview of the BEPS project. This was covered, the issue of excessive interest deductions was covered under BEPS Action 4. And the whole idea was that the traditional instruments that were used to curb excessive interest, such as thin cap ratios, like the one we have in Kenya, are no longer working. One of the reasons they're no longer working is because a multinational is able to manipulate how much debt to put, how much equity to put, so as to remain within the 3-to-1 ratio in Kenya. And you know, money is flexible. You can move around money quite easily, especially in the context of a multinational. Also, there was a realization that fixed ratios are not industry specific. Yeah. So if you have a 3-to-1 ratio, is that for all industries or some industries? So then it wasn't working to that extent. And there was also the additional problem of trying to determine, now that you have determined what the interest is, what's the arm's length interest rate that should be. So because of those problems, they tried to think of ways to try and simplify. And I think the two approaches they're using is a fixed ratio rule, which is the ratio of interest to earnings before interest and tax, which is called interest to EBITDA rule. And you can use that together with a group ratio rule, group third-party ratio rule.
And maybe you could just tell us a little bit about the group third-party ratio rule.
So in recognition of the fact that different multinational groups will operate in different industries. So for example, a multinational in the oil and gas industry, in the power sector, will have different capital requirements. And therefore there should be some flexibility as to how much a taxpayer in the oil and gas industry should have vis-a-vis somebody operating, say, in the general services industry. So the group third-party ratio is a recognition that we can allow a higher interest deduction for some people operating in specific industries.
Okay. And if I was to ask you to predict which way Kenya would go, do you think some of this will be adopted, all of it will be adopted? Is it a good thing? Is it a bad thing?
I think Kenya can borrow some aspects from BEPS Action 4. Say, for example, one of the things that they can try and do is prescribe, like the fixed ratio rule, to specific industries. So you can say for this industry, because it's capital intensive, we'll give you a ratio of up to this much. Yeah? Another way that Kenya can try and adopt this recommendation is to try and define what level of EBITDA are you looking at. So is it your accounting EBITDA or is it your taxable profit? And I think the whole spirit of interest deduction is that you should be allowed an interest deduction to earn taxable profit. So maybe that definition should be that the EBITDA that we look at is the taxable profit.
Obviously we see that corporates are taking on more debt, there's more investment, whether the investment is through capital or whether the investment is through debt, and higher leverage in the companies. If some of these reform measures are adopted around thin capitalization, do we see the sort of tax advantage that exists for financing through debt being reduced, and equity and debt being treated from a tax perspective more equally?
I would say what the reforms are trying to do is to reduce the disparity between the tax benefit of financing through debt compared to financing through equity. So maybe the disparity is too wide and we're trying to bring them closer together. But so long as the tax regime continues giving a tax deduction for interest and no tax deduction to an equity investor, because a dividend is not tax deductible and it's also taxed in the hands of the investor. So long as fundamentally the tax regime is written that way, the disparity would continue, but the reform will probably reduce that disparity. And if the problem that the government is trying to address is giving incentives to debt investors, I think fundamentally then the tax regime should be rewritten so that there's no disparity between equity and debt.
I know one of the issues that we've seen tax authorities in Africa grappling with is around benchmarking interest rates, related party debt and interest rates. And there's a lot of complexity around that. Now, just picking up on some of the things that you've said, would this reform of ThinCap and the use of EBITDA ratios rather than fixed debt capital ratios, will that reduce that complexity of interest rate benchmarking? Does it take it away, or does it still, does a taxpayer still have to engage in that exercise? Yeah,
so the reform, that's one of the issues that the reforms was trying to target, because different revenue authorities have different capacity to do an interest rate benchmarking. They were trying to look over a more flexible and more simpler way to limit the interest deduction. So I would say, to the extent that a fixed ratio rule or a group third-party ratio rule is fairly easy. Once you define the terms that go into those ratios, it's fairly easy compared to an interest rate benchmarking. Then I would say that it could simplify things.
Okay, excellent. So I definitely thank you very much, Alice. I obviously will have you back when the income tax, the draft act or the draft bill is out, and we can see if some of these provisions you've recommended or are suggesting or think could be helpful to the Kenyan economy come through in the act.
Yeah,
So
thank you for
very
having
much.
me. I look forward to being back.
Okay, thank you.